Now the question is, Scott Limited has an authorized capital rupees 1,40,000. Sorry, rupees 14 lakh, divided into 8 lakh ordinary share rupees 1 each and 6 lakh 8% preference share of rupees 1 each. The following trial balance was extracted from its books as on 31st December 2015. Factory building within bracket cost rupees 9,50,000 and book value is 7,70,000. Plant and machinery cost rupees 2,80,000. Book value 2,10,000. Discount net 3,500. Profit and loss account as on 1/1/2015 45,200. Opening stock finished goods 73,500. Raw material 30,600. Work in progress 24,300. Work is in progress is we use for those goods which have not been either in finished goods or in the form of raw material. And then they are also called semi-finished goods on which some process is going on. They are under process, that is called work in progress. Debenture interest paid for first 6 months 7,600. 3% investments as on 1/9/2015 3 lakh. Patents 26,000. Purchase of raw material 10,40,000. Sales 15,50,000. Dividend paid 45,000. Debtors and creditors. Debtors are 98,000. Creditors are 84,800. Bank overdraft 32,000. 7% debentures 2,40,000. Universal social charges payable 4,600. What are universal social charges payable? When a person has more income than a stated limit, on that he has to pay universal social charges. This is like a health fund for which he has to contribute. Since in the form of tax it is charged from the worker and paid to the government. Therefore, company shows it's at its liability. Issued share capital. Ordinary mean equity shares 5,50,000. 8% preference shares 4 lakh. Total issued share comes 9,50,000. Direct factory wages 1,74,700. General factory overhead 26,900. Hire of special equipment 6,600. Sale of scrap material 5,800. Carriage on raw material 8,400. Administration expenses including suspense 22,600. Selling expenses including 3 months investment income 44,500. Total of both sides come 29 lakh 12,400. Now, the following information and instructions are to be taken into account. Number 1. The figure for finished goods includes stock which costs rupees 4,500 but now has a realizable value rupees 2,800. Realizable value mean market price. That is, finished goods are including goods whose cost price is 4,500 but market price is 2,800. But stock is always valued at cost or market price, whichever is less. Here the market value of the goods is 2,800. Cost is 4,500. Therefore market value is less. From finished goods stock we will subtract 4,500 and we will add 2,800. Number 2. Finished goods sent to customer on 31st December on sale or return basis were treated incorrectly as credit sales. The recommended retail selling price of these goods was rupees 9,000, which is cost plus 25%. That is goods on sale or return basis. Company had sent to a customer goods on 31st December on sale or return basis. Since the customer cannot confirm on 31st December, therefore they cannot be treated as actual sales. And since this has been treated as credit sales, so we will subtract from total sales and also subtract from debtors rupees 9,000 and we will add to the cost. Sale price is 9,000. Profit is 25% on cost. So how will I find out the profit? Suppose CP is 100, profit 25, selling price 125. On 125, profit is 25. On 125 upon 125. And on 9,000, the profit will come 1800. Therefore, the cost price of the goods would be 9,000 minus 1800, 7,200. 7,200 we will add to the stock. From sales we will subtract 9,000. From debtors we will subtract 9,000. And to stock we will add 7,200. Third, repair to plant and machinery amounting to rupees 2,500 were carried out during the year by one of the firm's employees. That plant and machinery was repaired in the company by one of the employees. The expenditure on repair was rupees 2,500. An amount of rupees 600 of this expenditure consisted of parts taken from firm stock, while the remainder represented as wages. So out of 2,500, rupees 600 is taken from the company stock, company material, and remaining 1,900 are represented as wages of that worker. The total repair is 2500. Out of that, goods has been taken from stock 600. So from stock we will subtract 600 because these goods have not been used for production. They have been used for repair of machinery. And 1900, which we have presented as wages, they will be subtracted because they are not productive wages. They are for repair of machinery. Therefore, from wages we will subtract and we will transfer to repairs. The next is provide for depreciation plant and machinery at annual rate of 25% on cost. On plant and machinery, rate of depreciation is 25%. On cost, that is cost price method, straight line method, from the date of purchase to the date of sales. That is, depreciation is to be provided always on cost price. From that date from which the machinery was bought and till that date the machinery is sold. On 31st October 2015, a machinery which cost 15,000 on 30th June 2011 was traded against a new machine which cost 36,000. What it means to say that on 31st October 2015, a new machine was bought for rupees 36,000 and in lieu of that old machine was given was rupees 15,000 which was bought on 30th June 2011. So from 30th June 2011 to 30th June 2015, it becomes 4 years. Then from 30th June 2015 to 31st October 2015, it comes to 4 months. Therefore, on 15,000 at 25%, we will find out the depreciation for 4 years and 4 months. It comes to 13,000. From 15,000, we will subtract 13,000. The depreciated value of the machinery comes to 2,000. And we have got an allowance of 1,500 that the seller give us for old machinery give us an allowance of rupees 1,500, whereas the depreciated value is 2,000. Therefore, we have a loss on sale of machinery, loss on machinery 2,000 minus 1,500 rupees 500. Now what it says, the check for net amount of this transaction was entered in the bank account, but was incorrectly treated as purchase of raw material. That is 36,000 minus 1,500, 34,500. A check was issued for 34,500 and it was recorded in the bank as purchase of raw material, whereas it is not a purchase of raw material but it is a purchase of machinery. So it means our raw material would have increased with 34,500. So we will decrease the raw material with 34,500. Then fifth, the suspense figure arises as a result of the incorrect figure of debenture interest. That is, in suspense account, we have an incorrect figure of debenture interest. Although the current entry had been made in the bank account and discount received rupees 500 entered in the creditor's account. Correct entry has been made in the bank account and discount received rupees 500 entered in the creditor's account. The figure for the bank in the trial balance has been taken from the firm bank account. That is, whatever figure of bank we are showing in trial balance, we have taken from the bank, firm bank. However, a statement dated 31st December 2015 has arrived showing an overdraft of rupees 30,220, whereas the overdraft has come for 30,220, the bank statement which we have received. A check for rupees 790 issued to a supplier had been entered in the books cash book as rupees 970. That there had been a mistake. The check was issued for 790, which we have entered in the books. Instead of bank, we have shown in cash as rupees 970. That 180 we have shown more. A credit transfer of rupees 700 had been paid direct to the firm bank account on behalf of a debtor who has recently been declared bankrupt. That to debtor we have paid a check of rupees 700 from the firm bank who has recently been declared bankrupt. This represents a first and final payment of 35 paise in the rupee. So from debtor, how much we were to got? We have got 35%. 35% rupee means 35%. The actual amount would be 700 into 65 upon 35 or 100 upon 35. That is, we have received 35%. How much was the total amount? 7,000 into 100 upon 35, 20 into 100, 2,000. Therefore, out of 2,000 we have received 700, 1,300 would be the bad debts. A check for fee rupees 900 issued to director had not yet been presented for payment. A check of rupees 900 was issued to director for his fees, but he has not presented this to the bank for payment. So therefore, our real bank overdraft would be 30,220 plus 900. 31,200, so 120. The director recommended that provision should be made for both investment income and debenture interest due. A provision for bad debts to be created equal to 5% on debtors. Factory building to be depreciated by 2%. Building you are to depreciate at 2%. Provide for bad debt 5% on debtors. You are required to prepare the final accounts of the company. Now cost of manufacture is 12,99,800. Then we are coming to the trading profit and loss account for the year ending 31st December 2015. Sales 15,41,000. Opening stock of finished goods 73,500. Cost of manufacture 12,99,800. Totals come to 13,73,300. Less closing stock 85,100. Now total comes to 12,88,200. Now gross profit 2,52,800. Administration expenses. Administration expenses are 23,700. Selling and distribution expenses. Discount 3,500 minus 500, 3,000. Selling expenses 46,700. Bad debts written off 1,300. Provision for bad debts 4,350. Totals come to 55,400. And the total of expenses comes to 79,100. Therefore, the net operating profit comes 1,73,700. Balance sheet as on 31st December 2018. Intangible assets. In intangible assets, we are having patents 26,000. What are patents? When we are using some other brand name for our products for a certain period, for 5 years or 10 years, for whatever period we want to use, we have to pay a certain amount to the company from which we are taking, and they are known as patents. The patents here are 26,000. They are intangible assets because we cannot see with naked eyes. Now tangible assets. Factory building 9,50,000 less accumulated depreciation 1,99,000. In amount column 7,51,000. Plant and machinery 3,01,000 less accumulated depreciation 1,13,700. In amount column 1,87,300. Investments 3 lakh. The total is coming 12,64,000. This is add working capital. What is working capital? Excess of current assets upon current liabilities. Now current assets here are raw material 27,100, work in progress 20,700, finished goods 85,100, debtors 82,650, that is 87,000 minus bad debts, provision for bad debts 4,350. Investment income due 750. Total of current assets is 2,16,300. Less current liabilities. Creditors 84,980. Bank overdraft 31,120. Universal social charges 4,600. Debenture interest due 9,800. The total is coming 1,30,500. Current assets are 2,16,300. Current liabilities are 1,30,500. The working capital comes to 85,800. The total as represented by capital employed 13,50,100. The capital employed as represented with, that is equity share capital, total capital as represented by 13,50,100. 7% debentures 2,40,000. Capital in reserve, equity share capital or Rs1 each. Authorized issued. Under authorized 8 lakh, under issued 5,50,000. 8% preference shares. Under authorized 6 lakh, under issued 4 lakh. The total issued capital comes to 5,50,000 plus 4 lakh, 9,50,000. Profit and loss 1,60,100. So therefore, the total capital implied comes to 13,50,100. Kindly like, share and subscribe this video. I have appended working notes in my description, and if you like, you can refer to the working note. Thank you very much.